Hello everyone, welcome to the second video. So today was a very big day, and it was interesting to see how the market reacted to it, and there are some interpretations regarding of how the market reacted, and it's important to take into account so that you guys do not miss out this long opportunity because we are at the moment on a rally up stage, and I'm going to explain why. But first, let's talk about the new Fed announcement. So, Powell announced that there will be 25 basis points interest rate hike, and he safeguarded in his speech while I was listening to it that he could use more hikes in case he felt it was needed. But the way that I interpret his speech is that as of now, he will avoid and will refrain himself from doing more hikes. And this is because of the banking crisis. The banking crisis that was announced back in the weekend. It was a bit more aggressive than we had information available on Sunday. So basically, Credit Suisse was bought at a much higher price than 1 billion. It was around 3 billion from UBS, but there was some assurances from the regulators. So basically, the Swiss regulators changed a lot their approach towards instead of rejecting what uh, what um, UBS was asking for, they decided to go through another way. So they provided a credit line of $100 million so that they could use in case they felt the need for it. Um, um, and but still, it's interesting to see how it unfolds because there has to exist a bit more information to know exactly what it means. But in practice, it's the governments in Europe, in this case the Swiss, are giving all the guarantees possible to the banks to ensure bank stability. And the same thing happened in the US. We had the Silicon Valley Bank that failed. And for you guys to understand a bit what happened in Silicon Valley. So we had last year, uh, a year ago, a near 0% of interest rates. And suddenly, within a year, these interest rates came up to 4.75 and now 5%. Now, what does this impact? What does this causes in the banking industry? So in the US, when you make a deposit in a bank, the bank is allowed to use your money and to lend to other banks or to make investments to get a certain return. Um, and there's in terms of law, there there is no minimum requirement for them to keep, let's say, um, the the structure of the bank on a certain capital level. There's no minimum required. So what happens is that the the, the Silicon Valley Bank, the risk manager, when the interest rates were hiking, um, from the information that we have until now, they didn't adapt to that new interest rate. So So imagine this. You are coming from a 0% scenario of interest rates. You are a depositor and you earn, let's for imagine, 0.10%. And this at a time. And then in a year, this is raised to uh, 5%. And your ability to earn money from a deposit as a depositor increases too. as a result of that. And what happened here is that the investments that Silicon Valley was doing with your money wasn't able to outpace this growth in terms of expense. And they had also lots of investments that didn't go well because of the raise of interest rates. So there was no risk mitigation. This is why, this is the reason why the Silicon Valley Bank failed. So, and this of course created a domino effect because people wanted to withdraw money, etc. So the bank failed as a result. This is mainly what happened with the Silicon Valley Bank. And then in, in order to avoid other banks to be affected by this, the government of the US decided to create uh, a credit line structure to ensure that they would not that the banks would have all the insurers in the world to keep things alive and working well for the economy. So when we see this kind of news, it's a very bullish news because if there's a crisis, there's something going on, it's showing that something got broken. But at the same time, we have the government intervening and saying, no, 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 all will be fine. Basically, there's no reason for to sell off any asset. It's reason to stay in it and to buy and to go long. Now, what happened today, and now with all this information that we had accounted for, included in it, including what happened today, what does tell us of the navigation of the market? So, in the previous episode, we had an estimated that it would hit as a start this resistance point, but it went a bit lower in S&P 500, and then it went up, and now had here a sell-off. This sell-off is healthy. Okay, when there is a push for a rally, or there's a, let's say, a very strong push upwards, and and there is no and then there is a pullback like this one. It's very healthy because let's look a bit to the numbers. We came from here, from 380.68 to 4,036, and, and this is a very quick, let's say, increase. It's very high. Actually, let me see if we can measure this. It would be more interesting so that you guys can understand a bit better. Um, I honestly have to explore a bit more the functionalities from TradingView, but basically, in practice, this is a very large increase in just 1 or 2 days. In just 1 or 2 days, we increased roughly. Let's do like this. We increased around 3% of the value of the S&P 500. It's a very large increase. So it's normal that this is followed up by a small sell-off, especially because the S&P 500 includes lots of different stocks that are vulnerable to inflation, vulnerable to interest rates. So this is a healthy sell-off. Now, what did I see during this sell-off? What was interesting to see during this sell-off? When the 25 basis point was announced, there was a jump, and it was telling us that the market liked it. The market enjoyed this. It thinks it's a good idea. But the issue that happened was, since we had this rally from here to the top, um, this is telling us that it's it's a too big of a rally. This that came from the 10th of March until the 22nd of March, it's a very large rally. So there was not enough time to consolidate these amounts before it goes really up. And if you compare with history, all big rallies had a small pullback. For example, big rally, pullback. And then we have a big rally. Now we have a big pullback, but this pullback it will be a more significant rally. And the same goes for the downside. Sell off, pullback, sell off. Let's look here another example. For example, rally, pullback, and rally. So there's always a consolidation phase that is needed, but there's always a pullback, and these pullbacks are healthy. This pullback was healthy. So what do I think it will happen now? I believe that we are going to find a support under these levels over here, and this will be a good opportunity to go long. And from here, the market should rally to test the 4,100 or even higher, depending on how the market reacts from now forward and how the economy reacts, etc. The economy, according to Powell, is a bit lower, but it's still expected a growth. He was a bit careful also on the part of us having a soft landing. So basically, what he's communicating now is that there is some doubts if there will be a soft landing on the in a year, because it's in a year that will be uh, the, let's say, one of the impact of the measures that we are using now in case we decide to withdraw them. So, and the other thing that he also shared in his speech was that in terms of labor market, there is or showing some softening. Now, there's some softening, but there is still a high demand on workers. And that's what he wants to pull down a little, to adjust. Until he is able to pull that down, there will still be an um, a way of there will be still pressure on inflation being high. So when he is able to tame a bit more the the working space, the number of employees, workers, etc., and the employers start to reduce their demand for professional workers, then it's when the things will start becoming more reasonable for Powell to start thinking, okay, now it's time to actually withdraw the interest rates. And he's trying to do this without breaking more things. So it was already broken the banking sector. Um, so the U.S. Intervened in Europe, the same thing. Now let's see what will happen uh, in the next days. So I feel that we're going to have a pullback here to 3,900, and then we're going to rally. This rally could be as a start to here into the 3,980, and then up again to 4168. If this doesn't happen, it can happen also something like this. So you just have to be prepared in terms of how to react to the market in these scenarios. It's also fair that something like this can happen. But I do think that in the phase that we are here now is a bullish phase. Let's look to some of the indicators to see if this statement is true. So we spoke about on the previous episode about the QQQs divided by SPY, which is basically Nasdaq divided by the S&P 500. And we can observe that there actually was an increase compared to the last episode. So this increase is again stating that the market is risk on. The market believes that we have there's reason to believe that the market should go up. So and this is a very important indicator. Let's go to the VIX. VIX had today an increase, and this was only today's session, not yesterday. But it started with a decrease. So it went to 20 and then it went to 22. If we look to this outlook on a long perspective, it looks to be on a low reading. And the low reading is between the 23, 22, 23, and the 9 and the 17 and 90. So it's between here. If it is here, it's on a healthy note. There's reasons to be bullish again. There's no reason here to starting embarrassed. In fact, wasn't it? I think everyone knows. Wasn't in this phase where the market rallied, January, etc. It was right. So VIX is coming down. This is a healthy sign. Let's go to the bond market, to yield bonds. So what can we see now? I'm making this video and I'm analyzing together because I didn't have time to prepare. Um, I just wanted to release it was a comment, so I hope you guys enjoy while I am preparing, analyzing this for you. So I don't know why this changed, but thank you. Okay, so what can we see here? Do we see a divergence here? It looks like a divergence, doesn't it? Look here. This one goes up, and here, this one went down. Again, what does it tell us? This is a bullish divergence, meaning there's no reason to be bearish at the moment. No reason at all. So on a daily time frame, we have a reason to believe the S&P 500 will go up soon also. Um, and I was just seeing if this had a longer scope, but no. If we on a longer scope, they are aligned from what I'm observing. They're more or less aligned. So we have this one and we have this one. Yeah, it's more or less aligned. So on a longer scope, they're more or less aligned, but on a shorter scope, there is a bullish divergence, which is positive. It's telling us that the market is going up. Let's study now the bond market. The bond market today, what did it do? Let's have a look. So, since the banking crisis, and I made the video, I think was more or less here. No, it was on this day. Yes, it was the day before Monday. So, on the banking crisis, we were here, and now it came down to 392%, and it's on these levels, consolidating. What does this tell us? That the market believes that in 2 years, our interest rates will be around 4%. So basically, it's communicating to us that the interest rates are coming lower, that the risk at the moment is lower too, meaning that is expected to exist a rally soon in the S&P 500 and the QQQ and the Nasdaq. So I truly believe that we're going to visit the next resistance line soon. Let's see the 10 years. The 10 years, it's the only one that I having a little of concern because the 2 years show us a bullish sign. But when we look to a long term, because the long term is also important to consider, it looks like it will be consolidating here under the 4, the 3, and then near the 4 again. And this is actually a bullish flag. This is not a very positive sign. So this is the only thing that gives me a little concern that it could exist another rally in the bonds market. So we need to be vigilant to understand if this this is actually going to happen. Because if happens, means that we are likely to get it for a crash in case the stock market didn't have a sell-off. Because that's what happens most of the times. Let's look to gold. Gold played beautifully. Um, it sold off, held, and now went up with the risk going up. And this up was due to a lower interest rates priced in the treasuries. And this is healthy for gold. So gold I actually expect to go up. Probably will consolidate here a little, but I do feel that this is a good spot to go long on the 90.50s, 90.40s in case you visit it again, and then go long. And then I'm seeing gold going to these levels to 290, 280, 200s, or and maybe higher. Gold is a very promising asset on the long run. Let's go to Bitcoin. Bitcoin shown today a very interesting reaction. So we had a sell-off that is over here, and it held. It held, and now it bounced. It already bounced 600 points. Let's say for 600 US dollars. I think it's impressive. Honestly, this is showing a promising development, and usually the cryptocurrency is the first one to jump. So what do I expect to happen tomorrow until the end of the week? I expect to see Bitcoin to go through these levels over here. Again, one more time, one more bounce, and then going up strong, but really strong. And I'm imagining that it will go first to the 28, then to the 31 700s area, and then goes up into these regions as I spoke in the previous episode. Let's go to oil. Okay, oil is bouncing, and here I want to uh, leave an important comment. Oil, it was very well positioned because it was here in the demand zone, and now what happens is that oil is just bouncing. It's not expected to have a huge rally as of now, and this is because the since the interest rates weren't held and then withdrawn, oil could be actually impacted by this. So it will depend a lot on the geopolitics situation also. But what do we expect is that oil can go to these levels to the 73, as we have here lots of a range where a lot of buying and selling exists and a lot of activity. So I do expect oil to go to around these levels, 72, 73, and then go back down to retest. And that's and the retest should go from here up and down and maybe consolidate a bit. But oil at this level, since it didn't have the bounce I was expecting, there is a risk of continuing to go down. So be careful with oil trades because it can happen something like this to go to the 50s. So it will depend a lot on the development of how this will be played. And this actually recalls me where I was trading a month ago gas, and it was, I can share, it was in this scenario over here. I think it's very similar. And I like to call out the similarities because the market tends to repeat itself. So if you compare, you have one, two, three, and drop. Here we had something very similar. One, two, three, and drop. So, and what is important to highlight from here is that these ranges, usually they are very tricky to trade. It's one of the hardest things you can trade, but you can also be very profitable at it. And the way to trade this is by having full respect for supply and demand zones. And in this case, since natural gas wasn't in, let's say, in a high demand zone, when I was doing the trades here, um, I noticed that here when I tried to go long, it actually broke, so I had to close the position. So, and here, if you check, it's exactly the same. So you go long, close, short, close, long, close, short, close, long, close, short, close. So you keep doing this until it breaks. Once it breaks, then you have to, okay, long, and then you close there and then short. So because this can, you have really to respect the stop loss. So in this case, if you want to know how I would trade it, I would do something like this. I'm here, and my target is until here, and I like to have usually a 2 ratio. So my stop will be a bit in this level. Uh, Sorry, no, this is wrong. So, yes, risk reward 2. So my stop would be here. And if you observe, here would be the entry point, boom, done. And the same vice versa. So to trade ranges is one of the most tricky things, but if you do this proper risk management and respect fully when you get stopped out, you make money. Because the what matters here is that the number of tries that you do, it usually outpaces the loss. In this case would be one, two, three, four trades, then other four trades down, eight trades. And here we had one failed trade. So in nine trades, you failed one, but you were successful on eight. And that's, I think, if I know well mathematics, and I'm not very good in mathematics, it's 88% hit rate high. So imagine what it is in a scenario like this. You are using in these trades um, a certain amount, like I don't know, $500, for example. So if you think about it, 81, 72. So it's not like this how it's calculated, but it's only for you guys to have an idea. It's 12% on each case. So uh, this times 500. This is $62 per trade times 8. It's another $500. And then you would have a failed trade, which would be the half amount of the 62 and a half. So it would be 31.25. So this would be your profit if you had traders by respecting these rules and these mechanics. So this is just for you guys to have an idea on how it's possible to trade dimensions like this. And there you have it. So I mean, this episode I'm going to leave it as it is. It's a bit late, so I didn't had much time to prepare, but I hope you guys liked it. I just wanted to leave a comment as I felt it was needed to give a bit of guidance in terms of what to expect now in terms of market moves. I do think that the market is going now to the upside. The options market actually sharing that. Here we see actually um, a small bearish flag, but what I think it will happen is something that either this will reject and go up after coming down to this level, and I think this level is actually very important, or it will go down until this level over here and then goes up. And I think this move will be on Friday. So it will be very, very interesting to see how the market will react in the following days. I don't think that we'll have any crash because it doesn't make any sense. As of now, we have no evidence that there is a recession risks. What exists is uncertainty, and uncertainty is two different things. So, but actually, before we close the day, let's check U.S. market watch calendar. Uh, so let's see. Yes, on Friday, we don't have that many important news. So we have the PMI. So on Friday we have the PMI. The PMI probably will set the pace. The PMI has been coming down, so probably will be a bullish day. And this will be a bit aligned with the the theory that I had. So Thursday, March initial job claims likely it still will come strong. According to Powell, there's still it's still very strong market, so it will push the market down, but it will create this bounce like this. So if the bounce doesn't come tomorrow, it will come Friday, but I think it will be tomorrow. So tomorrow we probably see the market go here or here, and then it will go back up, and it will be something probably my expectation, something like a wick like this. And the reason is because we are at the moment forming and it's growing the strength to start a bullish trend. So from this level to the 41,600, it's, in my opinion, the short term. After this, we need to analyze it at the time. We need to see what it is because as of now, the uncertainty increased and Powell changed a bit his speech. He's being more careful. So I do think that this is what will happen. So tomorrow, initial job claims, we'll have probably a wick like this one, and then the market will rally up. Thank you so much, guys. I hope you enjoyed this video. Please hit a thumbs up and subscribe in case you liked my analysis. Leave a comment and feedback in case you feel there's something should be improved or that you would like me to or would like to challenge me. It's fine also. I'm very open for feedback. I'm here to also learn and also to share knowledge. So I really hope that you find value with this video. Have a great day and a great week also. Bye.